unprecedented, unique, yet not so unique if you look back in history, times. They're different times than we've been through for the last 2, 3 decades. We're not used to it. Most investors have never been through inflation, experienced stagflation, been in a market where, honestly, in the last 25 years, have even been in a market where, at least in Ontario, we've seen real estate crash, where we've seen at the same time as real estate is crashing, pressure on all levels of business, any business that is capital intensive. So they have large inventory, they have to invest heavily in any upfront advertising or marketing, or they need a lot of machinery. Where I'm talking, manufacturing, pretty much any franchise, because you invest heavily in capital at the outset of that. Almost a lot of businesses, almost every business has a lot of upfront cost and a lot of capital expenditure, and it is difficult for these businesses to survive and to thrive in these times. So first, I'm gonna always welcome the floor to comments. That's what this show's about. So if you guys have questions, comments, join the dialogue. Let's have a discussion about it. I like as a place to hedge your wealth during these times. Absolutely love businesses that are online with low fixed costs and are very easy to track profitability of each and every item, and in turn scale those items quickly without a lot of fixed cost. So it's one of the reasons why I like Meta, I like Facebook as a stock, just because they have that, I think, competitive advantage as a cash flowing machine to be able to generate while interest rates rise, they are not as heavily affected. Additionally, you'll want to look at businesses that, when you look at their balance sheet, look for businesses that don't have a lot of debt. Or if they do have debt, making sure that it's fixed in. Like there are examples of REITs, commercial REITs, and retirement home type REITs that have fixed in debt swaps that have basically forced all of their debt at a fixed rate of 2% or less. And so those businesses are not affected at all currently by rising interest rates. So those are interesting businesses. They're potentially being beat up still as real estate has crashed in some areas 25 to 30% locally, in some areas more. And so we're in a high inflation environment. They're having difficulty bringing down inflation. The rate hikes are the highest and fastest we've seen in a century. We've never seen rates go this far, this fast. A reversal of, in Canada as an example, I had a 1.24 5-year variable mortgage, 1.24% in January. It is now, after this next rate hike, going to be over 5%. Let that sink in for a minute. That's over a 300% rise in the cost of interest to carry that said mortgage. That has effects. Adjustable rate mortgages and variable rate mortgages in Canada and Ontario specifically are about half of all mortgages. So real estate is greatly being affected, especially now where in the spring and summer, as rates were creeping up, most mortgage agents, due to the stress testing rules here, were using loopholes to get people qualified at lower rates using variable rate products. However, that is now punishing them as the Fed continues into October, November, into this fall and into the spring. We may see 10% mortgages again. I don't know if it'll get that bad. Truthfully, I hope it does. The reason I say that is because our currency is collapsing relative to the US dollar. We need to show strength for our currency. We need to show that the federal bank and the Fed in general cares about inflation and is serious about fighting inflation. Inflation is more of a poison and a cancer for the economy than high rate interest. High rate interest, or high rates of interest, are also poisonous. Like they're also a cancer. They also suck, but they are a lesser evil than inflation running wild. And so for a time, we may experience both. And that's where you may look at certain industries and sectors. I've never been a big oil and gas guy, but for the first time, there's a really big opportunity. I talked about this in my stream in the spring. I was talking with a friend the other night about it. We are poised to have a similar crisis as the late 70s coming into this winter, an energy crisis that, especially because no one has invested in oil for the last 20 years or so, there's been a divesting and a reducing in production. And by the way, OPEC and everyone else, no one wants to invest in the space to produce more. So we have a supply side issue and a demand side issue, and supplies are drying up. So I really feel like, for me, it's about so for me, it's a really great opportunity, I think, to potentially look to sectors like oil and gas this winter, where you could potentially have opportunities in Europe. And if you look at the supply shortages, I guess, with what's going on between Russia and Ukraine, you could profit on that. But moreover, I think even regardless of that, a lot of these businesses, because of the divesting, I do see opportunity there where a lot of the certain quality companies have reduced the debt on their balance sheet significantly and are paying healthy dividends and are buying back shares. And so some of those businesses produce 15, 20, 25% cash on cash in the oil sector. As prices of oil continue to rise this winter and we experience real shortage, it is possible that you could get a squeeze of 50 to 100% upside. Just in general, I think it's also a place where you could park capital and in the short term through this recession, have it ride out and do much better than in, say, tech. I don't know how I feel. A lot of people are flocking dividend stocks, but even some of the dividend stocks right now, I don't know how I feel about them when you compare to the other opportunities that exist in a high interest rate environment. Why would you invest in a bank stock that yields you 5 to 6% when you can literally go out right now and fund private mortgages at 10 to 15%, or go get treasury bills at 8%? The capital is going to dry up out of these other opportunities, I think. Tech, everyone's afraid to be in tech right now, though it is the future. And I think everyone should have tech in their portfolio in the long term. We are seeing it not, as an asset class, not rotating as well. Now let's talk about private sector pieces. So for me, I think that businesses that are involved in, well, anywhere you have a competitive advantage, by the way, if you're watching this and you're like, dude, I'm in like the, I don't know, pick a business. You're in like the e-learning space. And you're like, I just sell courses. I'm like, that's, by the way, as much as I think that, the course business is overexploited by certain characters who get out there and sell things and don't fulfill their promises, I think that there is also a really big space for value add in these times right now. People are struggling to flip. People who used to be able to flip easily before because they had bad operations and they had a bad buying process, but the market was carrying them. People were getting appreciation 10, 20% a year. So it's hard to mess up in those times. Those people, they need coaching and they need mentorship and they need accountability now more than ever. And I think there's a certain type of person that benefits greatly from those types of programs. Additionally, I also think that people are shifting away from traditional brick and mortar college and university and finding their own path. And I think a piece of that budget, that say $80,000 you used to spend over 4 years in a brick and mortar university to learn, well, at least half the time you're learning about stuff that didn't matter, that you would never use, that had no value, that was forced into your major. You can now divert those funds and take a more efficient, focused stream. So I kind of agree with Alex Hormozi that space does very well in a recession. It's probably one of the best places you could be investing right now because it's not affected in the same way. You have course sales that a lot of them are 70, 80% profitability, a very low cost to deliver, highly scalable, no real capital needed to sustain it. So if interest rates go from 2% to 20%, you're largely unaffected, right? And because it's such a high profit margin, easy to scale business, it's just a great one to be invested in during these times. So despite what some people might say, consumer spending dropping, I think people typically in a recession tend to invest in themselves. They stop spending on luxuries, they start investing in education, they start building their businesses. This is the time to be investing in those things. So I think there's a lot of opportunity there. I'm going to move into that space in a meaningful way in the coming months. You guys hear me now? There, resetted the Wi-Fi, reconnected the Wi-Fi. There, I think I'm reconnected. There. Did it work? Can you guys hear me? Stupid Wi-Fi. Bell, curse you! I have both Bell and Rogers, but the problem is I have to switch between them. It's such a pain. I literally subscribe to both internet providers because just in case one goes down, internet is such an essential service to what I do that I would literally rather have two of them for redundancy purposes. And still, they go down. Welcome to telecom companies in London, Ontario. I'll go to the question and answer period because I lost my train of thought. Dick's Junk Removal says it was 20% in 1980. Yeah, I mean, I don't think we'll get to those same levels. There are a number of reasons why that happened, and I don't think it will happen in the same way this time. We can learn from history. We can observe what went well and what didn't go well. You've got to remember that we came from some of the lowest interest rate environments we've seen ever. And we have such a debt load. Companies have such a debt load now, and prices have inflated so high that even the average government can't sustain the debts to each other at those levels straight. It results in war and chaos. If those rates stay high for a sustained period, if we went through the 80s again it would be disastrous. Tax rates would have to rise to levels that are unprecedented. I'm talking like 3/4 of your income gone to sustain just the carrying cost of debts between nations, right? Because raising prime interest, like especially as the U.S. raises rates, it's collapsing other economies. There are economies like there's like a dozen of them you could name off the top of your head from like Venezuela, Argentina, like all those South American countries, in the Middle East as well. There's several countries in there like Turkey that have 40, 50, 60% inflation right now. And they're trying to peg to the US dollar, and they have debts in the US dollar, and it's crushing them. As the US is apparently, I think Powell is sort of serious about raising rates. I don't know if he's serious enough. Hopefully he is, to strike fear in the hearts of people in order to crush and sort of satisfy any demand that existed, to drop demand. The whole focus is demand side. They're not focused on the supply side at all. They're focused on like, how do we drop demand to drop inflation? By the way, there are better ways, I think, to tackle inflation, but that's the path they've chosen to go with. And so it is what it is. But my point being that we're in for some real pain in the time and months ahead. I think that there is real opportunity here too, though, if you're cognizant and aware of the fact that you can diversify into various assets, which I've partially talked about here. And I think diversity is important. You don't have all your eggs in one basket. If you're a crypto guy, don't have it all in crypto. Even if you're a crypto guy, if you're a real estate guy and like that's your competitive advantage, still don't have it all in real estate. I like real estate better than crypto. I always have, because of the intrinsic value and the underlying use cases. I think that crypto is great. I like that you can stake it. I like that you can, there are a number of use cases for it as well. And I think it has a place in the world, and I think it has a place in our future for sure. Blockchain technology is going to be, and decentralized finance is going to be a path for the future. The question is, which horses do you bet on, right? And so with real estate, there's only so much in the quality areas, and it will always have value. People always will need somewhere to live. Even if we evolve into a metaverse where we all live online 10, 12 hours a day, I actually think that's a possibility the next 20, 30 years. But I will say that you still need a place. You'll still need a house to go to plug in your VR, to escape into this new reality, right? So housing, brick and mortar, I think will really, will really hold itself well in the coming years. So I like it as a place to park capital as well. With flips and with buy and holds, I think it's important. The equity can come or go, but the cash flow is what you really have to rely on. So if you're buying properties that can cash flow and do cash flow well, same when you're buying businesses in these times, cash flow is everything. The valuations of these businesses are greatly affected by the current long-term run rates and the discount rates that are largely affected by what the Fed decides from the cost of capital perspective. So some of these valuations, these companies, we could see 50, 60% drops in valuations of all private businesses. That is a great opportunity, by the way, because if rates fall again, then you got to buy a business at a discount rate of, maybe you got to buy it at 50% off because it was using a rate of, say, 12% long-term cost of funds, and then cost of funds falls to 4%, and it's easy to collect capital again, right? It's a different time. And so these opportunities, I think it's important to also have some cash on the sidelines. So if you have lines of credit, you have some cash. There's nothing wrong with keeping cash in this time. I know everyone's talking about inflation eating your cash up, but the opportunity cost, I think, of that cash is a greater opportunity. So don't lock it up in a GIC for 5 years. I could see the argument though. People are messaging me like, oh, could you park it in something short term? For sure you could. You could park it in some short term, bridge financing type loans where you're making 12 to 14%, and it's like a 6-month term. I'm going through a foreclosure process actually right now where I lent out a mortgage on someone's house, and I'm taking back, basically I'm taking the right of the property and then forcing the sale of it and taking what's left of mine. And that process has been informative to learn how long it takes. It's a lot faster here in Canada than I thought it was to take back a house when someone doesn't pay. We're talking a couple of months and you've got the house back. It's not like at all like when a tenant doesn't pay, which could take a year. Another reason why I've invested now, and I'll let you guys know, in our business. I've joined forces with 2 other operating partners, and I now own with them a property management, Airbnb property management and re-rental business. So if you have properties, by the way, when you're watching this, and you have a property in Burlington or Hamilton or London or Sarnia or Toronto, we're heavily in Burlington and in those areas. we're looking to expand in pretty much any market that will make sense. If we can get 3 properties there, it can make sense for us to scale that market. So if you have some properties in a market, we would be open to considering re-rental. We don't take every property. We're very picky. It's got to be new build. It's got to be newly renovated. It's got to be like a top tier A quality type property. But those properties, you have so much upside potential. Why would you ever limit? I mean, whenever you put a tenant into a property, you take a huge risk, here in Canada anyway, that the tenant destroys the property and you have no restitution at all for that. So for me, I'm like, this is a natural evolution where I honestly just want to rent properties and re-rent them out, do corporate placements, do monthly rentals, but I'll do a 2-year lease where the property's basically, I'm controlling that asset. You've handed over your asset to me. I give you checks every month. It's done. All your expenses are paid. We stage the property. Day 1, we're going to add 10% value to the property. A really nicely staged property will appraise for 10 to 15% more. It will also sell for 10% more. So your property immediately, if it's $1 million house, becomes worth 1.1, 1.2. So we've added 6 figures in value immediately. So everyone's like, well, what's the value add? Why would we rent our house to you? I'm like, well, 1, I have an amazing credit score and a strong financial backing. When I rent your property, you get rent no matter what. 2, I'm a corporate rental. So if I don't pay, then there's a much easier recourse to go after me, right? Whereas a tenant, it's not the same. 2, your property stays, not only is it worth more money, but 3, that property stays in better shape longer. When you're frequently cleaning it and inspecting it, floors last longer. Shower caulking, just as an example, like maybe a tile shower, you caulk the corners and you caulk along the base of the tile shower. If you clean that on a weekly or monthly basis, it lasts longer. Your finishes last longer if you take care of them and have frequent cleanings. The nice thing is Airbnb just charges for damage. Corporate placements, again, you just go after them for any damage. You can just it can be a profit center. You can literally replace furniture. So it's a really great business that I've been wanting to dabble into for a long time. I've had properties on Airbnb that we've managed since early 2017. We had a couple of projects that we dabbled with. We were one of the first people, the first people that got called out by the city of London on one of the tiny houses we did that was not 100% legal. So that one wasn't great. I've also hired 4 property management companies over the last, how long have I been doing this for? 5-6 years that I've been involved in Airbnb at least. And I've seen some horrible property management companies that still exist do Airbnb for me. I did a re-rental once to someone who was a scumbag who didn't pay. So I've learned, I've been on the other side of this. And I'm like, I saw, by the way, I have a couple friends who are good operators. And I'm like, okay, so what are the differences between these bad operators and these good operators? And I've taken some of those lessons. I think the best way to learn is through emulation. So you look at what other people are doing, you learn from those lessons, and you do it better, hopefully, or just as good. Or you take pieces from each one and you make it your own in a unique way. And so it's a business that I think is important. I just don't like the prospect of having someone in a property while inflation's running at 10 or 15%. I don't like the idea of having someone in a property that can choose to not pay for a year. And you're forever fighting them to get them out, or they do damage. I've just seen so many horror stories of myself even, where I can't get tenants out and tenants don't pay. And you don't get that with corporate re-rental. You just don't. You have a quality tenant there. If you don't have a good tenant, you kick them out and you bill their credit card. It's as simple as that. So I really like this business in general. I like the scalability of it. I like that if you run your numbers properly, you can control great assets and it's a win-win for the other person as well, because they're getting market rent with a quality tenant, right? And their property is fully staged. You ever walk into a rental with a tenant living there and it's like, there's dishes and they've got their personal possessions there and all of that. It doesn't look that nice. If you ever want to refinance it, bring an appraiser through, you ever want to sell it down the line, you're limited, right? So I think that's a big piece of it too, is just, there's a need and I want to service that need. So that's another business that I've now invested in. We are scaling up rapidly. We'd like to get to 50 units in the next 6 months. We should be at 20 units shortly within the next few weeks. So if you have a property and we can onboard it, we can fit it in and it meets the criteria, there's an application process effectively. You'd have to send us videos of the property, send us the address. We can do some due diligence on our end and decide if the property makes sense. 85% of properties out there will not make sense. They won't be a good fit for us. But there are, if you have a really well renovated property and it's in a decent area, it's probably a good candidate. And it would be something you could hold and have passive income. You don't have to have a property manager. You get to save that 10% property management fee. You don't have to pay a tenant placement fee of 1 month's rent, which is the standard in the industry, because again, we will take care of that for you. So it's like you're getting property management built in, and I get to arbitrage the difference. So if the market rent of that unit is say $3,000 a month, I'd give you $3,000 a month. And I'm hoping that I can go take that and put it on the market and make 5,000 or 6,000 a month. In the low season, maybe I'll lose. In the high season, maybe I'll win big and be in an opportunity to make a bunch of profit and help solve the problem for landlords at the same time. So it's a business that I want to invest in. I like the infrastructure. You guys know my long-term plan between being in Costa Rica, Bahamas, Florida, specifically, especially in Florida. We're going to be scaling it in Florida as well. And then cottage country here in Canada, as well as any rentals that I have. Like, this just makes a lot of sense to me. Sorry, my kids are really running around outside this room. Apologies for that. That's just, I have 3 girls, so there's always screaming and they're, always having the time of their life or fighting, or both, having the time of their life and fighting with each other. But I just thought it was a great opportunity, and so I'm excited for what's to come. It's a logistical business that I think fits nicely into my long 5 and 10 year plan to have those in-house systems and people to be able to scale and grow. And if I acquire assets in those areas, to be able to then plug and play internal management gives me a value add piece, as well as when I'm JVing with people or just in general. It's just nice to have that piece in the backdrop of being an expert in the operations side of the business. Again, so many property management companies suck. So many Airbnb management companies are terrible. I'm surprised just how many of these companies don't have dynamic pricing. They're literally manually typing in the price into Airbnb. If you don't have CRM systems and you don't have software that's automatically changing the pricing and the ad based on, like, Airbnb is literally just an SEO engine. You have to understand SEO in order to get your property to rank. And pricing is very, very important in that aspect, as well as titling, keywording, pictures. There's a whole bunch of variables that are important, but so many of these listings are bad. Some of these managers don't care. Like, they're on holiday and they're like, whatever. What? What do you mean whatever? It sat vacant for a week. Like, I'm learning from where I've seen people fail, and I'm trying to apply those learnings to help and to deliver value. And that's really how you build a successful business. And whatever you're doing, whatever business you're investing in, deliver more value than you're charging. If you're coaching people, deliver more value than you're charging. It's simple. If you're a construction company, deliver more value than you're charging. And you can charge more. But people are like, oh, I can't charge anymore. No one will pay me $100 an hour. Then you suck, or your people suck, or your marketing sucks. Something sucks. If you're delivering value for people and you're solving real problems and it's hassle-free for them, people pay $100 an hour. They don't mind. Doesn't matter what your business is. If you can deliver real value and find a way to deliver exceptional value, whether that's through, a seamless quality experience for the customer. A lot of the time in the luxury space, it's more about how people feel than the quality of the work. Like, the plumber that charges $150 an hour typically isn't that much better than the plumber that charges $80 an hour, let's say, or $100 an hour. But the reason they're charging 50% more is because they show up exactly when they say they're going to show up. They have great customer service. They answer the phone. They have, with a smile. They clean up really nicely when they're done. All of those things, it's little, like just literally wiping up the dust from your boot after you're done. It's a little difference that makes a huge impact. The wealthy person doesn't want you walking through their house, without the slippers on or something, right? Like, you put slippers over your boots. Little things like that I've noticed. At the higher end, you pay a lot more for not that much difference in product, but a lot more customer service and quality. So, all right. I'll go back to the Q&A here. What are your thoughts on starting an Airbnb arbitrage business, particularly in these times? That's timely. So I'm doing that, and I believe in that. You've got to be very, very careful in these times with the arbitraging piece. It's definitely, you can definitely lose money if you arbitrage without running your numbers. I'm a numbers guy, right? So, like, as soon as someone gives me a listing, it's like, hey, would you take this property on? Location is number one. I'm going to look at all of the data in that location to find out what are the average nightly rates, what are the occupancy rates. You go on AirDNA, you can find all of that. I think there's an opportunity there to dig into the data. And if you dig into the data, you'll find exactly where you're going to be from an income range perspective and find out exactly where, what you can generate from this property. And then ideally what you want to do is back out the cost of furnishing. If you're going to furnish it, you're going to, consumables, all the investments you're going to make from a capital and labor perspective to get this property just looking mint, and the designer costs. You're going to hire a designer to obviously design the unit and make it proper. A lot of amateurs don't hire a designer. It's a fail. Ideally, you want to do that as well. But yeah, so all that investment. And then I think it makes sense to look for 2 to 3 times the rent to end up covering the cost of the furniture and all the investments up front. you're looking at least a year before you even break even with a re-rental. And so I've seen a lot of re-rentals fail. And I know people have tried re-rentals in London here and tried them in Toronto. And I know some people who tried them in the US and have reached out to me and shared their experience. And I've seen a lot of failures. And I see where the people fail is typically in the early on. So the three areas I see people fail the most is one, I see execution is a huge fail. They're just not good at running the Airbnb. They don't do dynamic pricing. They just throw it up at like $200 a night and they have like a min max and that's it. They have no software. They're not trying to run a CRM. They don't have good systems. So one, it's execution is where people fail. But two is the data. Like they just don't rent the right unit, the right place, the right setup. And so they're paying $3,000 a month in rent and generating $4,000. And so they're not making a huge margin and they have a bad month and they start losing and then they give up on the property because they weren't executing right and they didn't do their numbers at the outset to make sure it was a profitable location. Again, like I said, 80% of properties are not going to qualify for a good re-rental. So a lot of the properties out there are just not good candidates. And it's about knowing which ones are and which ones aren't. The third thing is the setup costs. I see people go crazy on the furniture and the setup. And there's a place you want to be in. There's a sweet spot. You don't want to go too cheap. But at the same time, if you want to spend like, if you're going to spend like $100,000 setting up a unit and it's not a super luxe unit, not generating a couple $1,000s a night, you're going to end up in a position where potentially, and by the way, this goes back to number one on operations, you put in a bad guest and that guest trashes the place and they can't afford to replace that furniture because their credit card limit isn't big enough. Now you got to litigate. You're in a position where potentially, it's your fault again for not executing well, but potentially you invested too much in furniture and you're looking at like a year and a half to get that money back. And it's a situation where it's just not good at all for the re-rental. So you can lose money, so be careful. Yeah. Bum, 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 bum. Do I still buy Bitcoin? I still have some Bitcoin holdings. I don't think it, yes, you could still buy a little bit of Bitcoin. I still believe in Bitcoin long term and other altcoins as well, like Ethereum and ETH. I just think that don't bet the farm yet. I don't think we're out of the water yet. I don't think we've hit a bottom yet. Max pain isn't there. So will it get worse before it gets better? Yes. Buy a little bit now. Continue to buy all the way down to the bottom. And then what you should see is the next bull market is the time to sell. So when things are euphoric, that's when you want to sell your Bitcoin. Mega Seth says, what should I do if I invested when the market was high and now I'm down 10 to 20%? Well, you're not alone. I think you mean the real estate market, but you could mean also just the stock market, because if you bought Facebook shares, Meta shares, or Intel shares, or any major company, Tesla, Nvidia, at the all-time highs, then you're down 20, 30, 40, 50, 60, 70% in some cases. So it's just pain. You have to decide what your risk tolerance is and your time horizon. If you can wait this out for the next 5 years and you don't need access to that capital, and it's just sitting there in a retirement account, hold those shares, whatever. If you got, and likewise, if you have I come at stock investing the same way I come at real estate. If you're holding a real estate asset that produces great cash flow and you're on a fixed rate mortgage, or you've run your numbers so that if rates get crazy on variable, that you're okay. Again, I think it's important to hold and ride it out. Now is necessarily not the best time to be selling. That said, if you have another opportunity with that capital, something else, like you see another property that's like 50% off and it's an amazing deal, you're like, I could sell my property for at market value and make a great return by investing in a lower cost-based asset, I could see the argument for selling. But don't just sell for the sake of panic, like it may go lower, I'm going to sell. I don't think that's prudent. I think that if initially you looked at the property and you ran your numbers and it cash flowed and it made sense, who cares about the equity? The equity comes and goes. It's the cash flow that you're focused on, right? And if it's cash flow positive, the equity will come. 5 years from now, everything will be up from where it is now. So exactly. Of course, it's entertainment purposes. Do whatever you want. I provide no financial advice. Schnuck says, could there be oil and gas sector ETF you're looking at or are thinking of individual stocks? Smart observation for the winter, Mike. Well, I think we're in an interesting, and oil and gas has seen some spike already, and we saw a spike and then we've seen a bit of a retrailing. You got to remember that Europe has 1 month of supply left and they're cut off from Russia. And the Saudis are intentionally not producing and holding back reserves. And there's a whole push globally in almost every first world country to scale back production, to, protect the environment and to stop, any investment in oil and gas. And that's created, and also the fact that we went through a really bear oil cycle where like oil got to a point like from a cost, I think at $30-40 a barrel, there wasn't even profit for most of these companies. So it was a rough time. And because of that, we're now going to see the whipsaw of that effect. And I think things will get crazy. We could see $120, $130 a barrel this winter. And so I think there's definitely, it feels to me a lot like a pile of tinder and a match just waiting to fall on it. It also just feels like if I'm wrong and the war ends, let's say, like there are catalysts, like we go through another COVID variant 3 comes out and like the world shuts down again. And if that happens, there won't be as much travel. So then the demand for fuel will drop, supply chains will get crushed again, and there won't be a need for oil in the same way. So that would be bad. Or the war ends and, all these trade embargoes are done and these sanctions are done. And all of a sudden, Russia's oil supply, although Russia's oil supply is literally being bought up right now by China and India. India and China, which is like 2/3 of the whole world, don't give a shit. Like they literally just don't care about what's happening between NATO and Russia. Like, and not they don't care, but anyway, the U.S. is also just like as a general observation. The U.S. is currently the world standard, right? Their currency is the world standard. They are the largest economic powerhouse right now. That is changing. China and India, China specifically, is going to be the new powerhouse. China and India will overtake the U.S. in terms of raw GDP and in terms of setting the global standard. It will be painful for the U.S. that has a huge ego to swallow that pill. And so it's likely there will be an economic or physical war in the next 10 years. That'll probably be, it's possible it gets us out of this recession. It's also possible we have a huge boom, and then that's the next start of the next recession, right? The next cycle. Recessions have been getting longer and longer apart. If you look at trends over time, we used to have a recession every 2 to 3 years in the 1800s, and 3 to 4 years, and every 5 years, and then we have a big one every so often. And now we've been through a point where we have less recessions, and they're bigger and deeper and more often. So, or sorry, less often, but deeper. And so that's interesting. And the recovery of recessions now is much faster than it was in previous decades. And the argument and thought behind that is that the speed and transfer of information between companies and people is just way faster now. So it took a lot longer for recessions to take hold, for them to recover from them. Now we have data and everything at our fingertips. So it gets bad quick and it bounces back quick. It's also the reason why I think interest rates will drop and then come back quick. I think it'll be a V. I'm hopeful it'll be a V, but it's also possible that, there's some stimulus. So then we have to keep playing this game for a while. If they stimulate, the more they need to raise rates. It's more of an inflation issue because the stimulants, like when they hand out stimulus to all these people, it's basically just like printing money, right? And when you do that and you give it to people, you create inflation because then they have a bunch of money to spend that they didn't earn. And so they spend it frivolously. Or they spend it on essentials, but regardless, they spend money that they didn't earn. And Congrats on the new partnership. Thanks. As far as that specific question, it's probably smarter to buy ETFs, but I like to buy specific companies. Suncor, as an example, is someone that I like. CPG, there's a couple others that my friend sent me, which I could share with you guys next stream. I have to go back to the list and check. Stickman Finance says, I sold my house and dumping the proceeds into a GIC for a 4% redeemable. No, don't look into a GIC. There are so many better opportunities. I can get you an equally safe investment grade mortgage. Again, like a mortgage at 60% loan to value is as safe as a GIC. The government steps in if we drop another 40% on top of the 30% we've already dropped. It just won't happen. So you could do a safe investment where you have no chance of losing money. If you invest, you put a $500,000 mortgage secured against $1 million house. If the house was worth $1.3 million before, now it's worth $1 million. If it drops to 700, 800, you still haven't lost a dime, by the way, because you only lent like 600,000 against that house. Your chance of losing money is near zero. And there are opportunities with near zero risk right now where you can literally make a 10 to 12% return. So a zero risk, a 10% return. Why would you invest in GICs? They have a similar level of risk and a lower return. Just, I don't know, kills me inside to see people, park their money in bad places and not get great returns on that money. Will, good evening. Good to see you on. Stickman Finances, I'll be hunting in the spring market. I think there are better places you can park your money, but I can understand why. You need access to the liquidity, so it's a 6-month GIC or something. Okay, I get it. Yeah, okay, I get it. I can also see the argument too, if you had like a line of credit on your house or something, you put it on that HELOC, park the money there temporarily, and then when you need the money, it's there. Whereas investigate in something like a bridge mortgage might be locked up for 4 to 6 months or even 8 months. I guess if they stop paying, you'd have the mortgage, you'd have your money back in like 2 months. So it's actually not that quick. It's not that hard to get money back. Yeah. Someone's put a question at the bottom. Contracts to lend your own money at no risk, as you said earlier, 10% return guaranteed. Yeah, I mean, honestly, I think that why wouldn't you? I guess the only reason you wouldn't is you don't have access to these opportunities. You don't know of anyone who needs a mortgage. You don't have a good network. To me, it's like, I just know so many people right now who are begging to borrow money at like 15% interest safely, like with low loans to value. And so it's so hard for me to want to invest in GICs because I have so many screaming opportunities. At the same time, I'm sitting on like, I literally have like $500,000 cash sitting in CAD, just sitting in my account doing nothing. That is there for opportunities. And I need it liquid in case something comes on my desk tomorrow that I have to close on in a week. And so that cash has a purpose, and that's why it sits there. And if I locked it in a GIC, it wouldn't be great. I think it's saving me like 2% interest right now or something. No, it's sitting against my HELOC, so it's saving like 4.5% interest or 5, whatever, prime minus half or something. I think, yeah, we're in 5% interest or something right now. So yeah, literally just like pay down debt that you have on your variable rate mortgage. If you have a mortgage, by the way, that you can take the money in and out freely, just park the money there and you get a better return than GICs right now. So it's something. Next question. Mike, what do you think of mobile oil change service? I don't know anything about a mobile oil change service. There's a guy in my neighborhood who does tires. He rotates the changes out your summers to winters, and it's a great service. I use it. He comes to my house, takes care of it. Super easy. It's like the same price. His little overhead. So yeah, that makes a lot of sense for sure. I think that it's a cool business. I think more people would probably use it. Maybe because I'm in a position where I value my time a lot. I'm probably the consumer you would target. But yeah, it's a cool business. I didn't know one even existed. Seen a van with an ad for such a business. Yeah, I mean, I think that we are in a service economy now and people are lazy and they want things brought to them. I haven't even been to the grocery store in so long. We get our groceries brought to us and I literally open the door and the guy brings it into my mudroom. With Instacart, they go to the grocery store for us, shop for the things that I want. I can even price match and they bring it to me on a membership. Like, that changed my life. I used to grocery shop and now like grocery shopping, what is that? So there's definitely a need for some of these businesses. And I think that for someone like myself, where I value my time at several $100s an hour, it just, it's not worth it for me to go grocery shopping. The order of my groceries is worth less than my time, the whole order itself. So I might as well pay someone else who's worth $15 an hour to go do it. Yeah, I think that it can make sense, especially if you're a business person with a lot of value. What cities are you choosing to pick up properties in your Airbnb business? So we're currently in Burlington, expanding into Hamilton, KWC, London, Cottage Country. In Barrie, we have a unit coming online. Anywhere in the GTA, we can make it work. We would like to expand out west. I think there's a lot of opportunity there with the ski hills and things like that. So we will probably expand that area. I'm very keen. In January 1st, I'm going down to Florida. I'm going to be buying a bunch of property, and we'll be starting our Airbnb business there as well. Hopefully some rental, to find a nice mansion on Airbnb for $3,000 a night, where I can make 2 to 3 times the rent, and it can be at that price point. And I love a mansion, as much as anyone else. I love just the architecture, probably more than anyone else. I love the architecture, and I love those kind of properties and touring them. It's just fun. But buying them makes no sense. You buy these properties for $5-6 million. The current mortgage rate at 7%. Your mortgage is like $50,000 a month in this environment. It just doesn't make any sense. Your carrying costs. You can rent that property for $10,000 a month. And you can arbitrage the fact that the guy who currently owns it has a 2% mortgage and owns it 50% in cash. So there's a small mortgage that's locked in at 2%. You can take advantage of that. You can arbitrage the fact that someone else has a really cheap mortgage. And you can't get that. There's no way today I could buy and get the same terms they had when rates were cheap. So the only way for me to profit with large mansions is to rent them and re-rent them. And so that's a niche and a space that I want to invest in. I want to take advantage of the fact that if you've got a locked in mortgage at a low rate, you're sitting pretty. And so they win because they get a quality tenant that won't trash their place. They'll take good care of it. That'll add value to the property by staging it, et cetera, and so forth. And I win too. So it's a win-win. And they don't want to spend the time to put on Airbnb. And most people aren't good operators. And they want to stay in their lane. And they want it passive. And so when you create win-win relationships, that's just the best. So yes, what cities I'm investing in, right now it's lifestyle based, but we are open to investing anywhere we can get 3 properties that the numbers make sense. So some cities doesn't make sense at all. If it's in the middle of nowhere, it probably doesn't make sense. But it depends on the property, where it is. If you have a property and it's an A quality property, I'm talking like nicely renovated, new build, doesn't even have to be super high end. It just has to have really nice finishes and be clean, and it has to be at least an 8 out of 10 quality property. But yeah, if you have one of those properties or in a great location, we'd be happy to discuss corporate placements and Airbnb and rent it from you. Potentially manage it for you, but those opportunities are far and few between. I don't want to be dealing with property owners. Or sorry, I won't deal with anything. My partners don't want to be dealing with property owners. If we rent it, it's much cleaner. We can give you a report of how things are going every few months, but we don't have to do a monthly statement. And like being a property manager is fine. You make your 20% of rent. It's typically what Airbnb guys charge. So 80% goes to the owner, 20% goes to you. I much prefer to just set up a flat rent, whatever market rent is for the property, rent the property, pay all the expenses. We pay for all the utilities, everything. We furnish it. We put the money into it. We run it. And we don't have we're not accountable. So if we have a month that's like it's down, we don't have to explain to the investor, oh, it's down. We had a vacancy for a week. Here's the stays. Oh, we had this problem at the property. Oh, there was a repair of the door that got fixed and we built Airbnb and we get damages back for this. Like I just don't have to have someone I have to report to. So just removing that stakeholder is just great. With a rental, you remove that stakeholder. It's a lot easier to deal with. You're not explaining the nuances. You're just saying, hey, if we make over this amount, we get to keep that profit for ourselves. And basically, it's a way of investing in real estate with very little money down. And so it's a very scalable business. But yeah, I would say you're usually putting in like 6 to 12 months worth of rent into setting it all up. So it's not if you're not good at executing, you could lose a lot of money with your rentals. And you can end up with furniture that's worth a lot less, and the labor, the thousands in labor to set it all up and stage it all. If the person were ever to sell the property, you got to get a contract in place that they can't sell that property. Because if they sell that property on you 6 months after you bought it, you're screwed. You're a huge loss. So that's where you have to be more careful. When you're doing re-rentals, guys, just be careful for doing that. I still my main business to me is still my flip business. It's still in the transacting of real estate. So it's wholesaling it, assigning it, selling it, buying it, transforming it, flipping it. That's most of what I do. And that's the area where I have the biggest competitive advantage. It's the area that I know my capital I never lose money in that sector. Whereas in the stock market, I can lose money. In crypto, I have lost a lot of money in crypto. Crypto mining, lost my shirt in that too, right? Those are a lot of factors out of your control. In real estate, I dropped 30% and I still make money, right? That's what I love about real estate, is that I have a competitive advantage that allows me to stay ahead. Where was I? Here I am. Okay. How stringent do you think London will be on regulating these new Airbnb bylaws? Good question. I don't know. I've chatted with some other local operators who have said similar to their rental license program, where currently more than half of all rental properties in London have no rental license. More than half. As in the majority of all rental properties in London, Ontario don't have a rental license. It's illegal. You have to have a rental license in London, Ontario. So I think it might be a lot like that, where the crackdown is if they ask, then you do. That's how most landlords treat the rental license program here in London. So I think it will be an add-on to the current rental licensing program here in London. I think it will operate in a lot of the same way. So that's my forecast or prediction. But yeah, also with a re-rental, I'm not the property owner. So if the city comes around, it's I'm just a corporate, I'm just renting this. And by the way, monthly rentals also do corporate placements and partnerships with companies where they place their employees there. and you do a corporate agreement, say Rogers or CN Rail or another company, that's not short-term rental. Monthly rentals are not short-term rental, not governed by that. So there are loopholes. One, there are lots of ways around it. Two, if I'm just renting the property as well, I'm not the landlord. And the landlord's like, hey, I'm just renting out. Here's my lease. I'm not doing Airbnb. I didn't know the tenant was doing that. Then it's like a whole circle game. Like, what? I think they're specifically trying to crack down on small operators who are doing this. So that's who's going to be affected. And if anything, it'll drive rates up, right? Because as people take their Airbnbs offline because they're afraid, there will be less supply. The demand will stay the same because people are still traveling to Western and London for whatever reason. So typically when they regulate, it actually makes things better for those who know how to operate. But yeah, I mean, it's not ideal for the small-time operator who's going to do it themselves. So again, I like that insulation of like just renting it out to someone. And if they do whatever they do with it, you can claim deniability. Like, hey, I just rented this property out long-term. Here's a 2-year lease. I'm not on Airbnb. And you're like, oh, they're on Airbnb doing corporate placements? Okay, here, talk to them. You know what I mean? Like you can kind of, anyway, I think it's probably a safer way to do it in somewhere like London. 17 days left of the SPR, the amount that the US is draining the reserves. There you go. Do you redo floors in your house? If you did, is hardwood for your own residence worth it as far as resale, or is engineered hardwood enough? I honestly think it depends on the home. I did do some floors in my house. I kept the hardwood that I had in my house. It's beautiful hardwood. Where I could keep it, I did. We did replace some of it with tile and vinyl in a few places too. But yeah, I don't know. I don't think there's a huge difference between hardwood and engineered hardwood. I've heard people say it's just that much better. Honestly, I haven't noticed a huge difference in resale terms from having hardwood versus engineered hardwood. It's a little bit nicer. Maybe the right buyer would be like, okay, I appreciate that a little bit more. Honestly, I don't think it's a huge difference. The supply, by the way, is that comment I read before that. Yeah, we are in an energy crisis very soon. So that could be a place to hedge and invest. I'm gonna get that question. And here in the GTA, recommend using wheel strategy in this economic environment. So Tony, if you're going to wheel in this environment, what you need to be doing is making sure that you stop loss. So if you're gonna wheel, I think the way to wheel would be to, if you're gonna sell puts as an example at the wheel, why not also like create a spread? And if you're gonna sell and say, hey, I'll take the shares at 90, maybe also sell something at like 70 or 80, in which case that would spike, close that contract out and use that to buy more of the dip. So you spread trade. If you basically place if you want to be bullish, you could do a bull spread. If you want to be bearish, you could do a bear spread. You can run the wheel in either way, right? Like you could also just sell calls until you're assigned short and then sell puts until deep enough in the money that they close up the short. So you can run the wheel in either direction. In a down market, you can run it the other way. You could sell, like I said, just sell the calls, then get assigned short, then sell the puts. Round and round it goes. Oh, I just had a sneeze there. Tried to contain it, but I couldn't. So yeah, can the wheel make money in this environment? Yes. Do I like buying shares at a discount? Yes. Coming out of this bear run that we're in right now, into the next bull, the wheel will not be a great strategy. The wheel works best in a flat market or a slightly up, slightly down market. It doesn't do so well in a full tank down. It doesn't do so well in a full rip up. Typically in the 12 months following a deep recession, we have a 30 to 50% upswing. So I would expect we are going to, in the next 5 years, have a year with a 50% upswing. And the wheel will mean you will miss out on most of that. So for once, I think it's time to shift from the wheel to something else. I think it's better to hold the equities, as an example. That doesn't mean you can't hold the equities and sell covered calls. You could generate cash flow on the holdings. You can hold shares in Intel and then sell covered calls on it. I have a huge position in Intel, and I continue to sell covered calls on it, and I close them out on days that it makes sense, and it generates me an extra 2%, 3%, 4% yield on that holding. So that's great. If I sold them deep, it would have actually protected and generated me a 20 or 30% yield if I had protected my shares properly, but I wanted to have that upside swing, and I'm afraid to sell too deep in the covered calls because then you're going to be in a situation where you lose a lot of that gain. So it depends. In a flat market, covered calls do really well. In a down market, covered calls do really well. In a really up market, covered calls do not do so well. But don't you need contacts to lend your money? Yeah, I mean, you would need contacts or mortgage brokers or realtors, or you can get there and make those calls, and you develop a business really quick to do that. Raz, you could loan me money. Yeah, I would borrow money again and then make a spread on it for sure, potentially. The way I would structure it would be I would lend against my current properties and projects. So it'd be against one of my flips, against one of my long-term holds, secured against one of my assets or my company assets, GSA, something like that. That would be how I would structure it. And then whatever I do with that money is my choice. Because legally speaking, I can't take people's money and invest it for them and take a fee. That's not allowed. Now I could borrow money against my own assets, and then if I choose to go lend that out in fund deals and make a spread on that, that's okay. So you have to be very careful with securities people, is my understanding. In these times, fund ETF. It depends. I think there are better opportunities right now. So there's a lot of things calling for money right now, and a 5% return is not that attractive when you can buy companies at 60% off right now. Some companies. June says, hey, Mike, thanks for the great content. As always, what cities would you say are a good potential investment for real estate in Canada, specifically in Ontario? It depends. I like cities that are growing quickly. So that's something that when you're looking at the immigration trends in that city, that's important. I like to look at the different diverse sectors in that city. So it isn't all just, one industry or one sector. I like London, Ontario for a number of reasons for that. But there are other great cities too in Ontario that you can invest in. I don't like Windsor. I've been vocal about that. I'm not a huge fan of Sarnia. I don't like Chatham. I don't like small towns. I don't think they do very well for the majority of your portfolio. You want to pick a bigger city that's growing. So London fits that bill. There's a lot of cities in the GTA that fit that bill. Yeah. All right. I'm going to wrap the stream up. I'm through all the questions now. The government just doesn't want you to hurt the innocent consumer. So ideally you work with accredited investors only, and then you limit a lot of your risk and downside. But in general, they want you to have mortgage licenses, and they want you to be regulated. And it's all to protect the consumer who might lend to someone who's not financially strong and loses their shirt. And they want to protect against that. And they specifically want to protect against mortgage brokers making huge fees and having no financial involvement when it goes sideways. So they're tacking on like 5% lender fees. And then when it fails, they're like, oh, well, no big deal. I made 5%. So that's what you don't want to happen. You want sleazeballs. There's a lot of sleazeballs out there. I have a lot of ethics and a lot of, morals, and I wouldn't do that to people. It's not who I am, but that's why those rules exist. Yeah. All right, everyone. Thank you so much for watching. The secret to unlocking wealth are you. 3 levers and control your financial future. Spend less, earn more, and maximize returns and the difference. All right, everyone. We'll see you next week. And as always, you know where to find me on Facebook and on Instagram at Mike Rosehart. Bye-bye.